Welcome to today's session of our Emergence Global Conference. I'm Rhythm Gupta, your host for today, and we have the pleasure of speaking with Peter Mobbs, Managing Partner of Five Sigma Growth Fund, an EdTech-focused global growth fund. With over 20 years of experience as an entrepreneur and executive, Peter is both a two-time exited founder and a Series D lead investor. He has public and private company experience, holds degrees in commerce and law, and is a graduate of the AICD Company Directors course. Welcome, Peter. Thank you for joining me for this interview.
Hi, Rhythm. Good to see you again.
Brilliant. Now, Peter, before we dive into our discussion on sector-specific investing, could you please introduce yourself and tell us a bit more about your background and expertise in the edtech space?
Sure. My career started as a lawyer, and I was one of the lucky few to escape, and then started my career as an entrepreneur. So I kind of fell into education and technology. It was completely by accident, but I had my own company. It went quite well, and we sold the first company all the way back in 2006 to an American company called Kaplan, which was a listed entity, part of the Washington Post group, but it got significantly bigger than the Washington Post, in fact. I spent the next 20 odd years in that education and technology sector, and then started another business, and that went really well. We sold the majority stake of that to private equity, and then I started investing. So it started out as my own balance sheet, and then over time we started a fund. So it's a 20-year journey to where we are today.
Brilliant. Well, Peter, that's absolutely fantastic. And it is very safe to say that you have a wealth of experience in the edtech sector. Now, to begin with, can you share your personal story as both like a two-time exited founder and also a Series D lead investor? And if you could also share with us how that experience has informed your approach to investing in this space.
Sure. So, what I'm doing now is very different to being an entrepreneur. 20 years of toiling away trying to build. But what it has given me is a real appreciation for what the founders of the businesses are doing that we're investing in. So I'm grateful for all of the blood, sweat, and tears because it gives me that different perspective. So we built a couple of businesses. We got very lucky and exited one. In fact, the second business that we exited, we then bought back off private equity. So I'm not involved in the day-to-day anymore, but certainly a good streak of entrepreneurship. It was fun investing my own money, and I did really well out of it. So I wasn't ever sure whether I was a good investor or not, but we had a 10.1 times return on invested capital, which is a phenomenal outcome across 18 investments, 22 rounds across 18 companies, but it did get to a point where we needed to sort of professionalize what we were doing and allow other people to come on the journey with us and invest in those same companies. So 12 months ago, we started a fund called Five Sigma, which invests exclusively in education technology. But how we got to be, a lead investor on Series D is interesting in that we decided first that we were going to focus on late stage investments for a couple of reasons. One, because it's lower risk. And we wanted our investors to get the benefit of the global education market, but with low risk. And number two, because the path to liquidity in those investments is a lot shorter. If you invest early stage, you've got to be in that investment for 10, 12, 14 years. When you invest late stage, you can be in and out in sort of 3 to 5 years. So the path to liquidity is truncated. But so that was the logic in investing late stage. How we got to be a lead investor is interesting in that we led the most recent round for Go1, which is an Australian EdTech business. It's a $2 billion business based in Brisbane. But I'd actually known the founder for 5 years prior to this. So back when I was running my own business, Andrew Barnes and I had discussed the possibility of a partnership between our two businesses to share content, and for various reasons it didn't work out. But we stayed in touch, and I got to know his business really, really well. And I even had a personal investment in his business, which meant I was really under the covers. So it was really not that big a stretch for us to then say, okay, we've now got a fund, we've got more money that we can deploy. It's much lower risk for us to invest in something that we know deeply. We've known the founders for a long time. So that's how we got in a position to lead the last round with some serious competition, big names, SoftBank, Madrona, Microsoft's M12, you name it. All of the big names were there, but we were lucky to lead that.
That's brilliant, Peter. It is so great to hear about the track record and obviously the success that you've had investing in the EdTech space. Now that you talked about Go One, it would be great if you could actually walk us through your investment notes into Go One, and like having led the $100 million Series D round, followed by VCs including Salesforce, AirTree, SoftBank. So anything you could share, that'd be great.
Sure. So the process that we go through, Rhythm, is more akin to the process that a private equity investor would go through, compared to a very early stage VC. Because as most people listening would know, when it's really a really early stage investment, there's not that much that you can diligence, because it just hasn't been operating for a long time. Whereas Go One had been going for, I think, about 6 years at the time, and so there was a lot you could diligence. So we took it seriously as if we were making a much larger investment, buying an entire business. We had appointed King and Wood Mallisons to do legal DD, PwC to do financial DD and tax DD. So it wasn't a quick process. In addition to me knowing Andrew Barnes for 5 years, we then took another 6 to 8 months to get really under the covers. But what we liked about the business was, number one, they were the market leader in their industry. So they're an aggregator of digital corporate training. So they cherry pick the best of digital corporate training and put that onto their platform. So they've got the world's largest library of digital corporate training that they then license that platform out to corporates all around the world. But they happen to be the largest. So they've got the largest library of digital corporate training in the world, which was super impressive, which means they have scale. And there's always advantages and defensibility when you've got scale. So we like that. They have got incredible margins. I won't go into the detail, but 75% plus gross margins, which is absolutely phenomenal. When you're the market leader as well, you also have all of these other benefits where the more content that you put on the platform, the more the corporates want to access the platform. And when you've got more corporates licensing the platform, the more people that produce content want to be on the Go One platform because they're more likely to get royalties. So there's this network effect that spins, and it's very difficult to be second place in that market, but they're the market leader. So we really like that. So, I won't bore you with the detail, but there's some of the things that we looked at. We went very, very deep in our diligence, and they were some of the key elements that popped out. And amongst others, probably the number one thing was the team. This team is phenomenal. If you're listening and you're based here in Australia, we've got a lot to be proud of with Go One. They are one of the best businesses that we've produced here in Australia, but also one of the best founding teams. They're quite phenomenal.
That's brilliant, Peter. Thank you for sharing that. Now, you will understand that, specializing in a particular sector is a very common strategy for many investors. What do you see as a value if, an investor specializes in a particular sector, and how does that inform your investment decisions?
So it's really different. To give you some comparisons, the co-investors that I just mentioned into Go One were SoftBank, Madrona, Microsoft's M12, big names. But today they invest in EdTech, tomorrow they invest in health tech, the next day it's space tech. So they're generalists, so they have to be. And I'm sure they become very good at being generalists, but they can never understand an industry as deeply as a sector specific fund can. So this is what I've
Mhm.
lived and breathed for 20 plus years. And that gives us a distinct advantage that we can pick winners and identify risk factors in a way that a generalist investor just can't do. So it's just a very different approach. The market is still huge. When you think about
Mhm.
edtech, it's easy to fall into the trap of thinking it's really narrow, and it is a narrow niche compared to all of technology. But the reality is, it's huge. Like to give you some perspective, education is a $6 trillion industry,
Yeah.
almost 7 trillion. So it's one of the largest markets in the entire world. And ed tech only makes up around about 4% of that spend, but it's doubling over the next 3 to 4 years. So it's huge. So there's plenty of space to go really, really deep into that narrow universe of ed tech. So we've got some really distinct advantages over generalist funds. I think that answered your question. Did it? Was there a second part to it, or if I covered everything?
No, that definitely answers it. And it's really interesting to know. I myself did not think that, the edtech market would actually, sorry, the edtech sector would actually be that huge. But thank you for sharing the numbers with us. My next question is around like why and how should investors consider investing in a sector fund? And if you could also share your insights on what percentage of their capital should they invest?
Good question. So the number one takeout, I think, from this discussion is that sector specific funds perform better than generalists. And I'm not just making that up because I happen to have a sector specific fund. But if you Google this, Cambridge and Associates have done long term studies and found that the margin isn't huge, but sector specific funds deliver better returns. And it's probably because you actually are able to pick winners and discern risk factors better than
Right.
a generalist. So it does make sense. So that's the number one reason why investors should think about sector specific funds. In terms of what percentage of their portfolio, it doesn't make sense to make a sector specific fund your only investment. So it should form part of a balanced portfolio. And of course, this isn't advice. You should get your own advice. But if, for example, you said, I would like, some people say 10% of their portfolio should be targeted at private equity and venture capital style investments or alternates. Or you might say 40%. Ours is sort of between 40 and 50%. So it's a big focus. I like it. We're young. We've got time to weather storms. We don't need the liquidity. But once you've worked out what that percentage is, let's say it's 40%, you might say, I'd like sort of 20% of that to be made up of sector specific funds and maybe the other 20% to be made up of generalist funds. And probably within that, you have a little bit of early stage, a little bit of later stage, so you're spreading the risk. But it's obviously up to individual investors. But I wouldn't miss out on backing sector specific funds because the returns are better. It's as simple as that.
Definitely, and thank you so much. That is, I'm sure it's very helpful for our viewers. Now, Peter, can you also explain like how exactly does the sector fund actually work, and what investors should actually look for when they're making their choice of which fund they should invest in?
So a sector specific fund is pretty well the same as a generalist fund in the way it's set up. So they
Mhm.
have partners, they have portfolio managers, analysts, etc. They have a back office. There's no real difference in the structure. It's really just the investment mandate and the focus of those investments. So we go really, really deep into edtech. But if you think about edtech, it's K to 12, it's corporate training, it's higher education, you name it. It's language college schools or the technology that powers those. It's big, but the way we go about that is no different to a generalist fund. How does it impact on our investment decisions? Well, clearly we can't deviate. So once
Mhm.
we put a stake in the ground and say we're only doing EdTech, we can't then go and do a health tech deal or a space tech deal. So we have to stay really razor sharp and laser focused on that. So it, in a way, keeps us focused on the job. So it's not really any different to a generalist fund. It's just the way we deploy money, it has to stay within that sort of narrow niche.
Got you. Definitely, I can see that. Now, Peter, can you also explain to us how do founder and investor perspectives on a sector actually differ, and how do these perspectives influence investment decisions?
So that's a good question. I think from a founder's perspective, there's a few things that they take into consideration at least, and it's different for everybody. But when you've got a generalist fund, you don't really get the depth of knowledge and support that you might get from a sector specific fund. And this I'm not talking necessarily about our fund, but all sector specific funds, because they are backed by people that understand that sector, can offer
Mhm.
more support that a generalist investor just can't give. Um, so number one would be support. Number two would be knowledge, just giving a broader perspective on the sector. That, if you are just
Mhm.
doing language technology or corporate education technology or higher education technology, you have to stay as a founder focused on that. But when you've got an investor that looks across the gamut, they can share broader and deeper knowledge.
Mhm.
And then I think the third factor, for me at least, is credibility. And I know that some founders have talked to us about this, but if you've got a generalist on the cap table, other investors always wonder, does that generalist, even if it's the best of the best, Madrona, Microsoft, AirTrees of the world, do they really understand what they've invested in? Because tomorrow, as I said, they'll do health tech and space tech. So
Mhm.
there's always a question mark as to how credible is that investment. But when a sector specific fund comes on board and says, we've looked across the sector and we choose this one because we think this, with all of our knowledge and experience, we think this is a winner. That's a real,
Mhm.
it's an endorsement of that company. So it really gives credibility to the founders that a sector specific fund has decided to back them. Um, I think I've answered your question, but
You did, absolutely. And thank you for sharing that. Now, for my final question, Peter, it would be great if you could share some insights on how to discern opportunities in the edtech sector.
so we break it down. You've got to start at first principles and think, what
Mhm.
is the sector that we're investing in? And because we've put our stake in the ground and said we'll only invest in edtech, then that means that we won't invest in education businesses per se. So that means businesses that are actually delivering education. So a college, for example, we wouldn't invest in a college. We're much more
Mhm.
interested in the technology that powers those colleges. So that there's a differentiation, I think, that you have to make between what you're investing in. So we only invest in ed tech, which means we won't invest in colleges. We won't invest in health tech, space tech, etc. And then we have to break down that whole market, because ed tech is so broad. It sounds niche. In reality, it is broad because you've got corporate training, you've got K to 12, you've got language schools, you've got higher education, the list goes on, and different focus
Mhm.
areas within that. So while it is a niche, it's still so broad, and we take a relatively broad view of what we will invest in. So we'll look at all of those, but some are harder to invest in and win on than others. So I really like, for example, the technology companies that power corporate training, because it's such a big market, and the barriers to scale are lower. That, K to 12 is really interesting and it's huge as well, but it's also tougher. We look at them all the time, but if you're selling into schools, it's, you sell into one school and you win, but then to get into 100 schools, you've got to sell into 100 schools. It's a very long process. So we cut and dice the market and identify the areas that we really want to play in the most, and then we focus just on the later stages where the risk is lower. These businesses have already gone through the valley of death, they've popped out, and they're the winners. So we're only interested in backing those winners. So it's not rocket science, but we're looking for the market leaders, those businesses with long-term defensibility, big margins, and globally scalable.
Amazing. Well, Peter, I honestly have to say that it's truly been such a delightful conversation with you today. And I want to thank you for sharing your insights and expertise with us and all the viewers. It has been a pleasure speaking with you and also learning so much more about the sector specific investment in the EdTech space. Before we wrap up, I want to let all our viewers know that we will be hosting the Emergence conference in Sydney on 23rd and 24th of March and in London on 31st of March. So if you're interested in learning more about investing and connecting with other industry professionals, be sure to register and attend the conference. Thank you again for tuning in. And again, Peter, thank you so much for your time. We really
Thank you,
appreciate it.
Rhythm. Good to see you.
Thank you.